Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And on today's show, I have to stop right here for a moment because I have to do a couple things on my computer here. I'm in the process of subscribing to a multifamily apartment complex deal. Yeah, that's what I'm doing right now. Oh, that's not what you don't care about that, or do you care about that? Are you interested in what I'm doing? And the reason I'm starting the show off this way is to make a point. I'm making a point. I'm making a point that I can invest in real estate at any particular time during the day, during the week, during the month, whenever it makes sense for me to do it. I can just do it. Now, this thing I was filling out, this subscription agreement, what this is, it's a legally binding contract. It's a legally binding contract between another Lifestyles Unlimited member and myself. And essentially what this thing does for me is it allows me to indicate to this other member that I am on board with their investment, that I've had the opportunity to review the investment, that the investment makes sense for my investing strategy, that I have done all the due diligence that I need to do to make sure that this is the right asset to go in my portfolio. And once I've checked all those boxes and everything is lined up, I execute what's called a subscription agreement. Now, the subscription agreement is prepared by an attorney. There's a lot of very detailed information in this document. And what this document does is it essentially creates the framework for how the asset will be operated, how it will be managed. Everything about the investment is actually identified in this document. Now, this document doesn't get into the nitty-gritty about projected returns and things like that. What it does do, though, is it sets the left and right limits for how the operator, in other words, the person that I'm investing with, can operate this property. And it also puts into motion the fact that I will become a passive investor, that I will from time to time have an opportunity to articulate my thoughts on the deal, but I'm not going to get involved with day-to-day operations. I'm not going to get involved with making decisions on the property. I'm going to let the other Lifestyles Unlimited member do that. Now, this other Lifestyles Unlimited member that I'm potentially investing with is what we call a lead investor. Now, lead investor it's a Lifestyles Unlimited term. It's a term that we use. Now, a similar term outside of lead investor, outside of Lifestyles Unlimited would be a syndicator. In other words, somebody who is syndicating a real estate investment opportunity. And part of the reason at Lifestyles Unlimited, we don't call our operators syndicators, we prefer to call them lead investors, is because that term syndicator, it's kind of a nasty word. It's kind of a dirty word. It's got a stigma to it. It totally has a stigma to it. And the reason it has a stigma to it is because there are people out there that syndicate real estate deals that will strip out all of the profits and leave you with a whole lot of nothing. Yeah, that actually occurs out there. And people that think they want to invest in real estate that are not properly educated, they're not properly trained on how to do this, they can get hurt. They totally can get hurt. Now, we call our guys lead investors specifically because we don't allow any of that shenanigans to happen in our real estate investing deals. We don't. We follow some very strict business rules which define, well, everything. They really do. They define everything about how we're going to operate, what our ethical stance will be, and because we operate in a membership world where we're not interested in taking advantage of our fellow members, we're interested in helping our fellow members, it's a completely different world. And as such, Del Walmsley, our founder and CEO, he just made the decision we're not going to call our investors, our syndicators, because it has a stigma to it. So we call them lead investors. And you know what? It's actually a beautiful term because they're taking the lead on everything. They're taking the lead on going out and finding the deal. They're taking the lead on doing the due diligence to determine whether or not that deal is going to work. They do all of the work to get the investment ready to be invested in. Yeah. Oh, yeah, there's a lot of work that goes on to do all that stuff. And when the investment shows up on my radar, when it's time to present that investment to me, I have the opportunity to look at that investment. Now, I get the opportunity to look at that investment because I established a relationship with that lead investor. That is very important because that follows Security and Exchange Commission rules and law. Period. End of story. We do everything the right way. So I've made that connection. That deal is made available to me to review. I should say it's called an investment opportunity. I like to use the word deal. I don't know. Maybe I'm just a little old school. So I'll review the deal. I'll review the investment opportunity, if you will, and I'll determine whether or not that investment makes sense for my investing strategy. Now, I will tell you this. I'm in the process of redeploying a lot of cash. And that's part of the reason I'm looking at a lot of different investment opportunities, because I need to get my money back to work. See, my money was working real hard for me. It was working extremely hard for me. And you know what I did? I sold everything. I have sold everything that I owned, with the exception of one single family house. I have one single family house still in my personal inventory. Everything else that I had, I sold. So what did I have to do? Well, I had to take all this money and had to get back to work. So what I'm doing is I'm buying apartment deals. When we come back from the break, I'm going to give you some insight as to maybe some things that you want to consider looking at when you consider investing in real estate. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. So I'm looking at an article that came out in early April of 2022, and it was written by Beth Matson-Teague. You'll probably recognize the name because I tend to cite a lot of her work, because I tend to think that Beth is in the Gets It Club. I do. I think she's in the Gets It Club. I think she's one of those journalists out there that actually does a really good job of analyzing data and then presents that data to you and then gives you an impression, or I don't know, I guess she's making a recommendation, if it will, of what's going on. But here's what I think about Beth. I think she gets it right more times than she gets it wrong. And I don't think she gets it wrong very often. So this article I'm looking at that she wrote says, pension funds eye higher real estate allocations. You heard me correctly. Pension funds eye higher real estate allocations. I mean, first of all, you're probably puzzled that I use the word pension funds, because pensions are a thing of the past, aren't they? I mean, they're really a thing of the past. You can't go to work today and get a pension. Well, you might be able to. I mean, they still exist out there. They do still exist, but they're becoming more and more scarce. And there's no endangered species thing going on that's going to protect a pension. To be honest with you, employers that offer pensions are probably scrambling right now to figure out a way to make pensions go away. And the reason they want to do that is because pensions are very, very expensive. They're very expensive. You're paying wages for people that don't provide any utility to your organization. Yeah, you're basically paying them to not do anything. Kind of like what the government did during the COVID-19 pandemic, right? They paid people to stay at home, do nothing, right? Yeah, okay. So pensions are doing something kind of interesting because pensions are looking for ways to generate income streams so that they can pay their pension recipients. So one of the ways they do that is they have massive buckets of money. Pensions have massive buckets of money. And they take these buckets of money and they deploy them into different investments looking to get a certain rate of return. As that rate of return comes in, what that allows the pensions to do is to essentially protect their principal and then make payments to their recipients off of the proceeds that they earn from the investments. I mean, that's essentially the concept, right? And the key thing is you don't want your seed corn. In other words, you don't want your original principal amount to go down. You don't want to tap into that principal amount because as soon as you start consuming that principal amount, there's less principal amount to use for investment purposes. Yeah, kind of interesting, huh? It's kind of interesting how the pensions funds look at things the same way you should be looking at what you're investing in, because what the pension funds are concerned about is they don't want to erode any of that principal amount that gets put into that bucket of money, kind of like what you're doing with your IRA, your 401k, your whatever you got out there, whatever you're doing for investing, right? And the key thing is, when you get to that point of retirement, you got this big bag of money and you're supposed to live off of it, right? I mean, that's what they tell you. But look what these pension funds are doing. They're not going to let that bucket of money erode. They're okay if you do that. I mean, that's fine for you, but not for them. And as a matter of fact, they're looking to buy commercial real estate that will produce returns north of 7%. You heard me correctly, north of 7% through the year of 2026. Now, let's stop right there and let's think about that for a minute. These pension funds are only trying to obtain an income stream of 7%. Why do you think they're not trying to go after an income stream that's much bigger? I'll give you the short answer. Because they don't have to. Because there is so much money sitting in that fund, they have determined that if they can get a 6 or 7% rate of return, they're going to be fine. Because the amount of money that they pay out will be covered by all of these income streams that come in. So 7% is a good number for them. As a matter of fact, 7% is probably on the high end of the scale for these guys. They can actually operate a lot leaner. They actually can operate a lot leaner. But they don't need to, because now they have an opportunity to invest in real estate that is projecting them to get a 7% return annually through 2026. You and I, we can't do 7%. I'm just going to come clean with you right here, right now, in your face, and I'm going to tell you, 7% return on a real estate investment is terrible. You heard me correctly. It's terrible. Now, you're probably sitting back and going, wait a minute, Al. Hold on, Al. I have heard you talk about investments on this particular radio show, real estate assets that could be acquired that are producing 7% rates of return. 7% rates of return. And I'm not going to argue with you. I'm not going to argue. You're correct. I have articulated that. As a matter of fact, I'm looking at a deal right now, right here, that is, now this is a single family house I'm looking at, that's showing me a return of 11.5%. Yeah, it's an 11.5% return, which is better than 7, and this one will do 11.5. But here's the thing. I'm only talking about the cash on cash returns on this particular deal. I'm just talking about the cash on cash. I'm not talking about all the different ways real estate makes you money. But you would think I am when I refer back to this article that Beth wrote that says that these pensions are going after real estate assets that produce 7%. And here's the thing, that 7%, they're also looking at the fact that these assets will go up in value. They are. They're looking at the same thing. But here's the difference. Okay, let me just be real clear with you. The pension fund can get by on 7%. Okay? They can. Because there's just so much money in principal there, they can afford to do that. 7% is a viable return for them, but not for you and me. See, if you and I tried to go out and buy a piece of real estate that only provided us, let's say, a 7%, or here, let's just use the 11.5% return that I'm seeing on this particular opportunity that I have. If you're getting an 11.5% return, let's say that works out to be, I don't know, $250 a month. Let's go light. That means that over a period of a year, you're going to make $3,000. Can you retire on $3,000? No, you probably can't. But I'm not suggesting you should. As a matter of fact, when we come back from the break, I'll fill you in on how to get it done. Stick around.
Warning, listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. All right, let me get into this article that Beth wrote. She says, according to the Pension Real Estate Association 2022 Investment Intention Survey, oh my goodness, I have to take a breath after saying all of that. But according to that survey, the average current allocation to real estate for institutional investors globally is at 8.9% with an average target allocation of 10.1%. That means these pension funds are recognizing that real estate is a better conduit for them to make money. A much better conduit for them to make money. And so as a result of that, they are starting to shift the amount of assets that they have to be larger based on the fact that it's real estate related, not some other kind of asset. I mean, that's essentially what they're doing. They're repositioning all of their holdings to increase the number of real estate assets that they have in their portfolio. Now, you might be thinking, well, why don't they just like junk all that other stuff and just put it all into real estate? Well, it's actually not a bad idea, but here's the problem. Those pension funds, they've got rules that they have to follow. They do. They have rules that they have to follow. They have people that oversee them to make sure they're not getting out of their lane, and they have to stay within their lane. The other thing is this. You can't just arbitrarily decide you're going to sell everything in the portfolio because it's underperforming, and then take all that money and just go out and buy a bunch of real estate because it's in the too hard to do box. It is. Because when we're talking about these pension funds, we're talking about billions, maybe even trillions. Yeah, trillions of dollars. That's just too much money to move at any given time. That's why it takes them time to change their positioning, because they do have to sell some assets, and then they have to go find assets to buy. And the thing with real estate, it's not as easy as buying and selling stocks. It's not. I mean, you and I could just go on the internet, with our bank, we probably have an opportunity with our bank to buy and sell stocks. It's probably like right there. It's probably available to us. All we got to do is push a button, fund the account, and then we buy whatever stocks we want. Yeah, they don't care. Buy as much as you want, sell as much as you want. They don't care because they're making a fee off everything they do. But when it comes to real estate, you can't buy real estate as instantaneously as that. You can't. Well, okay. There's a thing called a REIT. There is a thing called a REIT. And a lot of people think that a REIT is buying real estate, but it's not. What you're buying is something similar to what I would consider maybe a mutual fund. I don't know. I don't know that stuff that well. But you're not really buying real estate because what you're buying is something that you're buying through the exchanges, the stock market exchanges. Yeah, let's be clear. And you can go in and out of those investments as easily as you can with a stock investment. So it's really not investing in real estate. See, with real estate, it takes time to transact. It does take time to transact because there's a lot of things involved. Now, if we're talking about, say, a single-family house, it's really not that difficult to buy and sell a single-family house. All you have to do is look for the asset that you're interested in, make sure that asset meets your investing criteria, make sure that you're not going to overpay for it and you're not going to overspend on the rehab. And if everything looks good, you acquire it. You rehab the property. You put it back into service as clean, functional workforce housing. You find a great resident to live there. They pay you every month. The place is all fixed up. You're not going to have very many, if any, maintenance issues because you should have fixed everything that could have potentially gone wrong over the next 5 to 7 years. So there shouldn't be any problems. And that asset pretty much goes on cruise control for you. It does. And when it comes time to selling that asset, you can decide anywhere along the way that you want to sell it. But if you do that, you may want to take a look at your lease document to see what exactly you've agreed to with the resident regarding the sale of the property. Yeah. Now, the other thing you got to take into consideration is that lease that you have on that property, that lease is binding. It's binding. Let's say I have a house that I want to sell, and I just executed a 1-year lease on that property, and I just put that property on the market. Now I've got a bunch of people that want to buy the property, okay? But here's the problem. I can't sell to any of those people unless they're investors because that lease is binding. Just because I decide to sell that property doesn't mean I get to throw my resident out. Oh, hey, I've decided to sell. I sold, so you got to move out now. No, it doesn't work that way. It takes time to transact real estate because it's a different investing modality than what you're used to with the stock market or your mutual funds or whatever your financial planner has got you set up for. Now, what about these apartments? Well, scale it up. There's no other way to say it. Just scale it up. Let's say you've got a 100-unit apartment community. If you're getting ready to buy that 100-unit apartment community, one of the things you're going to do is you're going to figure out what is it potentially worth now and what is it potentially worth in the future. You're going to look at some market demographic data to determine whether or not the asset will go in the direction you want it to go financially. And if everything lines up and it makes sense, you will attempt to buy the property. Now, you go about buying the property by executing an LOI, a letter of intent. Basically highlighting some basic deal points just to get the current owner's attention. If the current owner likes what you present in the LOI, then you can move forward to actually writing a legitimate offer to purchase the property. But as part of this legitimate offer to purchase the property, you're going to do a lot of feasibility. You're going to do a lot of inspections. You're going to walk every single unit in that apartment community. And you're going to walk every single unit in that apartment community so that you understand what the physical condition is of each of those units. And you're going to grade it on whatever scale you choose to use so that you know, okay, unit A gets a score of 2. Maybe 2 to you represents there's $200 of work that needs to be done. Maybe unit number 2 gets a score of 8. And maybe 8 means there's $5,000 of work that has to be done. So what you're doing through the due diligence and the feasibility period is you're going through and you're checking on some of the assumptions that you've made, and you're making fine-tuned adjustments to your projections based on the information that comes back on these feasibility studies. And then once you get all the data, you kind of crunch it real quick, and you're going to know pretty quick whether or not you're on target or you're off target. Now, if you're on target, everything is great. Just keep proceeding with the sale. If you're off target, in other words, let's say you do all these inspections and then you find out that, oh, well, during our inspection, we determined that there's about $50,000 worth of plumbing damage that you didn't disclose, Mr. Seller. So we need to talk about that. And here's the other thing. You gave us an indication that the units were in a certain level of status. In other words, a certain level of quality. Now, we've walked all of the units and we've determined that your number's a little bit off. As a matter of fact, there's not that many units that are as good as you said they were. So as a result of that, it's going to cost us more money to do the things that we need to do, which means we either are going to renegotiate the price at this point, or I'm just going to have to step aside and let you keep your property. See, this is a very important piece of real estate investing. It's knowing when to walk away. And I'll tell you this, when you get trained by Lifestyles Unlimited, you know exactly what triggers the walk away. When we come back from the break, we're going to talk about making money. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. All right, so I'm looking at another article that came out. This one was written by Bendix Anderson. Now, both of these articles can be found on wealthmanagement.com. Wealthmanagement.com is a free, I guess, online magazine that focuses on the real estate markets. It focuses on a lot of things, but I do appreciate what they write with regards to commercial real estate and specifically the multifamily component of commercial real estate, because I'm not interested in investing in just any form of commercial real estate. I'm not. I'm not interested. I'm not interested in industrial. I'm not interested in hotels. I'm not interested in retail. I'm not interested in restaurant. I'm not interested in hospitality. I'm not in. Okay, see, I can keep this up for a while. The only one I'm interested in is multifamily, because we have determined at Lifestyles Unlimited that residential income producing properties, and when I say residential, I'm talking about the stuff that people live in. I'm not talking about student housing. I'm not talking about senior housing. I'm not talking about mobile home parks. I'm talking about apartment communities, and I'm talking about single family assets. Single family assets, by the way, include not only just single family homes, duplexes, triplexes, and fourplexes, sometimes called quads in different parts of the country. Multifamily is any collection, essentially, of 5 units or more. Now, it doesn't mean you go get 5 houses right next to each other and you call that multifamily. That's not really multifamily. That's 5 single-family houses right next to each other. Now, multifamily means you got 5 units that are contained like on one parcel or within one building or several buildings. Does that make sense? Okay. So in the multifamily space, people are making a lot of money. And it's not that real estate just all of a sudden decided it was going to start making people money as of last week. And Okay, maybe real estate decided that, but it's been an ongoing decision. It really has. Because real estate is doing extremely well right now. So much so that pension funds are adjusting their mix of investments to include more real estate assets in the mix. And if the pension funds are smart, they're going to do what we do at Lifestyles Unlimited. They're going to avoid all that other kind of commercial real estate, and they're going to invest in multifamily assets. Yeah, I don't know if they're thinking that way. I really don't know. That's my advice to them. But here's my other advice. I would just soon see them go out and buy all that other commercial real estate and not compete with me for the commercial real estate that I want, which is multifamily. And here's why. These big, faceless, nameless entities called pension funds or these other funds that are out there, they're huge, they're massive. They can afford to overpay for assets, and they can afford to make a very minimal return on their money because they're okay. They're totally okay. Yeah, I mean, when you think about these giant entities, there's so much money sitting in these entities that they really probably don't have to go out and do much of anything. But because they're not allowed to allow the principal to reduce, except for a very, very, very good reason that is fully approved by all the stakeholders and the decision makers involved, they have to go out and make a profit. They have to make a profit because they use that profit to pay for all the overhead of operating that entity. And trust me, it costs a lot of money to operate a pension fund. It does. They're big, giant firms. I mean, literally, a pension fund is a firm. You got a bunch of people working for that pension fund, doing all the things that need to be done so that the pension fund grows at the rate it intends to grow at. But if you and I try and grow our real estate investment assets the way a pension fund does, we might as well just give our money to the pension fund. No, I'm serious. You might as well just give your money to the pension fund. Oh, you can't do that, can you? Because it doesn't work that way, does it? Okay. All right. So you can't give your money to the pension fund. So maybe you just might have to do it the way I'm doing it, the way the 50,000 members of Lifestyles Unlimited are doing it, which is the smart way, the informed way, the way that will get you retired in the next 5 years or less. I'm serious as a heart attack about that. I'm serious. Let me go back to the single family deal that I was talking about. And you're like, well, wait a minute, Al, you were just talking about multifamily. Why are you going back to single family? Because it doesn't matter. Truly, it doesn't matter. Here's the point I want to make. This deal that came across my desk today, it's just a little 4-bedroom, 1-bath, no garage house in San Antonio. It's about 1,225 square feet. Not a real big house. But for somebody who has been living in an apartment, this particular house could represent the move upward in their family. So all of a sudden now they're no longer living in an apartment community. Now maybe they're able to rent a house and have a yard and a little bit of space around them instead of having people on the other side of the wall. Okay? These are things that my customers desire. Yeah, see, I know what my customers want. And by the way, a 1,225 square foot house is normally bigger than the apartment community that these individuals moved out of. Trust me. They're probably living in an 800, maybe to 1,000 square foot, possibly 1,100 square foot apartment, a 2-bedroom, maybe a 3-bedroom, and maybe their family's growing. And a house like this, well, it meets the bill. It meets the bill. This particular house, you can buy for about $26,000 cash out of pocket. Yeah. No, you're not paying $26,000 just for the house. What I'm saying is you're going to buy the house. You're going to do the repairs. Your total cash out of pocket to do that is going to be about $26,000. Oh, and by the way, now get this. You're going to capture something called equity. In other words, because you're going to buy this house, renovate this house, and put it back into service as clean, functional workforce housing, you will capture equity because all of your pricing going into this house will be at wholesale values. As a matter of fact, this house is worth, in the open market, it's worth $185,000. And what the numbers are telling me is that your all-in cost is going to be closer to about $158,000. So the difference between that $158,000 and that $185,000, that's equity that you capture in the deal. That's instant wealth that you acquire. Now, here's another beautiful thing. I told you earlier, this house, based on the rent projections and everything, because values are actually going up faster than rents are right now, this house will probably only produce about $250 worth of passive income. In other words, $250 a month coming into your household. But it still represents a $3,000 raise annually to you, not to mention you captured, what did I say, $22,000 in equity in this deal? Yeah. And you only spent $26,000 of your own money to do the deal, meaning your equity capture is like, it's right around the 90% range. It's effectively you doubling your money. Yeah, this is cool stuff. Now, here's the other thing. Let's say you're owning and operating this property. Let's say you only have enough money to buy one property. It's totally fine. Own and operate the property. What I would like to see you do is I would like to see you operate that property for 3, maybe 5 years. Get the utility out of the rents. But the other thing I want you to do is I want you to make an assessment as to where you think this property is going to go to price-wise, because prices are going up. We're in a huge seller's market. Prices are going up way faster than they've ever gone up before. So as a result of that, you have to pick a selling price where you will consider selling. You don't have to sell, but if it gets to your price, you have to consider selling, because maybe at that price that you established, that's the point where you stop losing efficiency and velocity of your money. And it makes more sense to sell the asset, harvest the money, and then go out and buy 2 assets to replace it. You heard me correctly. You go out and you buy 2 assets to replace it. Now, I'll tell you, I mentioned a seller's market, right? Okay. I've been selling off my single-family stuff. I had 5-year timelines. I hit my timelines in 15 months. That's the craziness of the market. I'm not saying it'll be like that forever, but that's the way it is right now. And if you want to understand how to harness it, go to lifestylesunlimitedworkshops.com.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.